First screen. Market tide. Triple screen begins by analyzing the long-term chart, one order of magnitude greater than the one you plan to trade. Most traders pay attention only to the daily charts, with everybody watching the same few months of data. If you begin by analyzing weekly charts, your perspective will be 5 times greater than that of your competitors. A trader has 3 choices: buy, sell, or stand aside. The first screen of the triple screen trading system takes away one of those choices. It acts as a censor who permits you only to buy or stand aside during major uptrends. It allows you only to sell short or stand aside during major downtrends. You have to swim with the tide or stay out of the water. Second screen, market wave. The second screen identifies the wave that goes against the tide. When the weekly trend is up, daily declines point to buying opportunities. When the weekly trend is down, daily rallies point to shorting opportunities. The second screen applies oscillators to the daily charts in order to identify deviations from the weekly trend. Oscillators give buy signals when markets decline and sell signals when markets rise. The second screen of the triple screen trading system allows you to take only those daily signals that point in the direction of the weekly trend. Third screen, intraday breakout. The first screen of the triple screen trading system identifies market tide on a weekly chart. The second screen identifies a wave that goes against that tide on a daily chart. The third screen identifies the ripples in the direction of the tide. It uses intraday price action to pinpoint entry points. The third screen does not require a chart or an indicator. It is a technique for entering the market after the first and second screens gave a signal to buy or sell short. The third screen is called a trailing buy-stop technique in uptrends and a trailing sell-stop technique in downtrends. When the weekly trend is up and the daily trend is down, trailing buy-stops catch upside breakouts. When the weekly trend is down and the daily trend is up, trailing sell-stops catch downside breakouts. When the weekly trend is up and a daily oscillator declines, it activates a trailing buy-stop technique. Place a buy order 1 tick above the high of the previous day. If prices rally, you will be stopped in long automatically when the rally takes out the previous day's high. If prices continue to decline, your buy stop will not be touched. Lower your buy order the next day to the level 1 tick above the latest price bar. Keep lowering your buy stop each day until stopped in, or until the weekly indicator reverses and cancels its buy signal. When the weekly trend is down, wait for a rally in a daily oscillator to activate a trailing sell-stop technique. Place an order to sell short 1 tick below the latest bar's low. As soon as the market turns down, you will be stopped in on the short side. If the rally continues, keep raising your sell order daily. The aim of a trailing sell-stop technique is to catch an intraday downside breakout from a daily uptrend in the direction of a weekly downtrend. Proper money management is essential for successful trading. A disciplined trader cuts his losses short and outperforms a loser who keeps hanging on and hoping. The triple screen trading system calls for placing very tight stops. As soon as you buy, place a stop-loss order 1 tick below the low of the trade day or the previous day, whichever is lower. Once you sell short, place a protective stop-loss 1 tick above the high of the trade day or the previous day, whichever is higher. Move your stop to a break-even level as soon as the market moves in your favor. Afterwards, the rule of thumb is to move your stop to protect approximately 50% of paper profits. The reason for using such tight stops is that triple screen trades only in the direction of the tide. If a trade does not work out fast, it is a sign that something is fundamentally changing below the surface of the market. Then it is better to run fast. The first loss is the best loss. It allows you to re-examine the market from the safety of the sidelines. Conservative traders should go long or short on the first signal of the triple screen trading system and stay with that position until the major trend reverses or until stopped out. Active traders can use each new signal from the daily oscillator for pyramiding the original position. A position trader should try and stay with a trade until the weekly trend reverses. A short-term trader may take profits using signals from the second screen. For example, if a trader is long and force index becomes positive or stochastic rises to 70%, he may sell and take profits, then look for another buying opportunity. The triple screen trading system combines different time frames and several types of indicators. It uses a trend-following indicator with the long-term charts and a short-term oscillator with the intermediate charts. It uses special entry techniques for buying or selling short. It also uses tight money management rules.